Dear viewers, if any of you are investing in the fixed income space in the United States dollars, you could be in a very precarious position. The interest rates are closer to zero. The inflation on ground is going through the roof. In this episode, I am going to discuss how this negative real interest rate is going to affect you, what are the opportunities it might create for you. This is NRI Money Clinic for you, and I am Dr. Chandrakant Bhatt, investment consultant and a financial planner.
NRI Money Clinic. No hype, just the right advice.
Before I discuss the subject of today, the negative real interest rate, let us first try to understand what is exactly meant by negative real interest rate. Let's try to understand with the help of an example. Let's say that you are going to deposit certain amount of money in the bank, and over a period of 1 year, two things will happen. One, the bank will give you the interest for the money that you have deposited in the bank. At the same time, the prices of goods and services will rise. This is known as an inflation. And obviously, the goods and services will be costing higher the next year. Now, in a normal case scenario, the amount of money you make from the bank, your principal plus interest, should be more than the inflation which pushes up the cost of goods and services. If you have put about 100,000 in the bank, and if bank, let's say, gives you 2% rate of interest, so it will be about 102,000 next year. But if the prices rise by 1%, then to buy the same goods and services next year, you have to spend about 101,000 US dollar. So that means to say, by depositing money, you have made something more than what you have that 100,000 today. But think about another situation. What if the bank gives you 2% rate of return and the prices rise by 6%? It means to say next year you will collect $102,000 from the bank, and to buy the same goods and services what you wanted to buy using this 100,000 this year, you have to spend $106,000 next year. It means to say by keeping money in the bank, you lost a great deal of purchase value. This is called the negative interest rate. In a normal situation, it should not happen, but whenever negative interest rates happen, you are the person who stand to lose. This whole discussion boils down to one point. What should be the right interest rate you should get, or where should the interest rate be set? In a normal working economy, the interest rates have to be slightly higher than the underlying inflation. If inflation is 2%, probably the bank rate should be fixed at around 3% or 3.5%. If the inflation rate were to be 4%, then the bank interest rate should be 5% or slightly higher than the 5%. This is what happens during a normal working of an economy. Now, in case of United States, they were trying to kick up inflation. Inflation was never a worry for them. The central bank was always trying to target the increase in prices, and they said that they are comfortable if the inflation reaches 2%. For a long period of time, it was not happening. And the central bank kept the interest rates closer to zero. And this has been going on for a long period of time. In between, they tried to increase the rate a little bit, but then came the pandemic and again they pushed back the rates back to zero. Now, what is the current situation there? Now, when we looked at the last week figures, in the United States, the consumer price inflation shot up to 6%. Yes, you heard it right. The United States, the consumer price inflation touched 6%. The bank rate at 0% and the price inflation is at 6%, which means by keeping money in a fixed income instrument, the investors stand to lose more than 6% of their purchase value if this kind of an inflation sticks around. This is a massive problem. Now, why did the United States reach this particular stage? It is because of one is pandemic. It kept the interest rate zero. That means people can borrow very easily. And it started buying bonds. That means it started injecting money into the economy. The quantum of money that the central bank has injected into the economy is mind boggling. As per one of the reports, more than 25% of the United States dollars which are circulating now has been injected into the system during the last 2 years. Now, the outcome of this is this massive inflation. If this massive inflation, if it is not controlled, every person who is invested in the fixed income space can get literally lost and may start losing money. While the inflation in United States is at 6% now, where does the 10-year government bonds stand with respect to their yields? It is less than 2%. Inflation is at 6%, 10-year government bond yields are giving less than 2%. Is it a very common scene in US? No, it is not a common scene in US. If we look at the history of last 60, 70 years, very rarely the inflation was higher than the 10-year government bond yields. Yes, it was very rarely it was above the 10-year government bond yields. Whenever the 10-year government bond yields lesser and the inflation is higher, one thing that has been observed is gold will go through the roof. Gold will start climbing up. This is an unmissable signal that we can pick up if we look at the charts of last 60, 70 years. What's happening this time around? Now, if you have seen, the gold had touched close to $2,000 per ounce 10 years before, then it went through a downward phase and now again it started moving up. This is a response to the inflation that is there in the economy. When the interest rates are zero and when the inflation picks up, obviously gold will cover that lost ground, and because it is a hard commodity, it will start rising all over again. If this inflation becomes very sticky, the chances that the gold climbing much higher can never be ruled out. Now that I mentioned the consumer price inflation in United States is at 6%, what can happen going forward? The inflation could be transitory, which means to say this is only temporary in nature. Within a couple of weeks, it will show off cooling off and it comes back to the normal level of less than 2%. This is one possibility. Or it may become sticky. That means it will stick out there, it will not come off, and it creates panic. If it sticks out there, then the central bank will be forced to act. It will be forced to act in such a way that it will suck out money from the system, or it will increase the interest rate, or both can be resorted. Already, the central bank has said that they are going to bring down bond buying by about $15 billion per month. Just a matter of time. Now that the market expects in this year or the following year in 2022, the interest rates cycle in United States could rise slowly but steadily to bring down this particular inflation. If inflation becomes very sticky going forward, what are the possible events that might unfold? If inflation becomes very sticky and if it cannot be brought under control, one thing appears to be very certain is the gold prices may start climbing up higher from here. How much high it can go, it can never be predicted. But in an inflationary environment, it is certain that the gold catches up. It's just not the gold which is catching up. All the hard assets and all the hard assets like real estate or minerals, metals, these are the ones which will start climbing up in prices. If you are invested in a company which manufactures or mines these metals and minerals and the energy components, then probably they will do very well. But if you are invested in a company which consumes these as the raw materials, then the raw material prices may increase, as a result of which their ability to pass it on to the customer may become difficult because of the rising inflation. So such companies may suffer in an inflationary environment. When inflation goes up, two things simultaneously happen. One, the purchase power of the buyer comes down. Now for the same amount of goods and services, they have to pay a higher price. That means their affordability comes down. Because of the action of the government sucking out liquidity from the system as well as making credit more expensive by increasing the rates, then the credit demand will also come down. So this will be a negative for the equity markets. If inflation becomes sticky, it is fair to assume that this could be the point where the bull market will be halted, and eventually this may set a stage for the markets to correct from here onwards. This correction may happen sooner than what we have expected. It is said that bull markets will never end. Bull markets will only end when the central banks decide to kill a bull market. Probably with this rising inflation in United States, it's time that the central banks thinks to increase the interest rate. Probably the central bank action will bring down this bull market to a grinding halt. Dear viewers, I would like to hear from you. You could be watching this episode from some corner of the world. I would like to know what is the prevailing inflation in your country and what is the fixed deposit rates which are prevailing in your country. Please give your inputs in the comment section below. That gives me an opportunity to understand what is happening in different parts of the world. Dear viewers, the topic that I discussed today, the negative interest rate which is prevailing in United States, how it can impact you or what are the opportunities it might open up for you. If it helped you to understand this topic, please like this video. If you are a person who is watching this channel for the first time, or if you are yet to subscribe for this channel, please hit the subscribe button and press the bell icon. Don't forget to share this video with your near and dear ones. Thank you very much for watching this episode on NRI Money Clinic. I shall be back with you with yet another topic in yet another video very soon.
Press the bell icon for more details and subscribe our channel.